And welcome back to Yahoo Finance Live. Taking us to the closing bell, we've got Lindsey Piegza, Stifel chief economist, also John Lynch, Comerica's Asset Management CIO. We want to talk about what we've seen here in the past just about 15 minutes because we have pulled off some of the highs of this session. And you can see right now, we're looking at the Dow being down about 23 points. We've got the S&P 500. It's still positive, almost 1.5 points. And the NASDAQ is up about 47, almost 50 points. But when we take a look at where we're watching performance in the Dow right now, some of the losers as we head toward the closing bell, Procter & Gamble off by more than 1%. Walgreens Boots, they're down almost 1%. Goldman Sachs also off about 1% as we head toward that closing bell. And then the sector action today, as we keep an eye on this for you, you can see that we've been watching energy go up, but right now energy's still a gainer. It's up about 1%, with consumer staples down about 1%. We've got communication services also negative, but consumer discretionary is up about 1%. We're keeping an eye on all of this, Shauna and team, as we head toward that closing bell. If we can pull back and show you again that the Dow at this point falling about 31 points, the S&P 500 up just about 1 point, and there we go. We have a closing bell.
And that does it for the trading day today. Again, as we see the gavel come down here, marking the end, we saw a bit of a sell-off here into the close. The Dow closing off 31 points. The S&P just above the flat line, actually, barely holding on to gains. And NASDAQ, it was the outperformer all day as we saw a rebound in some of those tech names. The NASDAQ closing up just around 0.3%. Adam was mentioning the sector action that we saw today. Consumer discretionary, energy, and real estate among the outperformers. We want to bring in our panel. We have Lindsey Piegza from Stifel and John Lynch from Comerica, both joining us here. And John, first to you, just taking a look at the action that we saw today, consumer discretionary and outperformer. We saw some of the reopening plays catching a bid. What's your big takeaway from the action that we saw today, and then also what we've seen over the past couple trading?
Well, thank you, Shauna. Good afternoon, everybody. Yeah, today's session, I think, I'm delighted to see consumer discretionary participate because the cyclical versus defensive trade had really faded. That momentum had been lost, and consumer discretionary had been losing some momentum also. I do think that today's trade, if we flatlined on the S&P, last I checked, the 10-year was about 153. So that tells me that the market is pricing in another 4.5% year-over-year CPI gain tomorrow or Thursday, but not fazed by it. And I think the market is buying what the Fed's saying about these base effects and that inflation will be transitory, because it's curious that we're hovering near record levels with the S&P, but you don't have the momentum that we had 3 or 4 weeks ago when the S&P was hitting records yet again.
I'm glad you brought up that 10-year yield. And Lindsey, I wanted to ask you about that because inflation is an issue that a lot of people are worried about. And I'm looking at the note that you sent your clients on June 4th, where you talked about the gain in average hourly wages that we saw in the most recent Labor Department report. Is there concern that the wage inflation we're witnessing would lead to permanent inflation on the consumer front?
Well, right now what we're seeing is a disconnect between the amount of workers that companies are demanding and the amount of workers that are willing to enter into the labor market. And a lot of that is being affected by temporary factors. We see lingering health issues or persistent health issues as a result of the virus. We still are working out some issues with daycares and schools opening. And of course, we have these policies from the federal government put in place, specifically these enhanced unemployment benefits that in some cases are creating a deterrent from workers re-entering the labor force. But as we continue to see the economy reopen and as we see these policies expire in September, it's likely that we are able to reach a more normal equilibrium in terms of supply and demand in the labor market. So in the near term, we might continue to see some upward pressure in terms of wages. Companies that need workers now, they're providing bonuses and wage increases in order to get the incentive to get those workers in the seats. But going forward, as we do expect more workers to come in, growing the pool of potential laborers, I do expect these wage pressures to abate somewhat.
Lindsey, we've heard more and more Fed officials come out and really talk about that maybe now is the time to start thinking about tapering here or think about changing the easy policy that we've seen now for quite some time because of the pandemic. I'm curious just to get your thoughts on that, what you're thinking just in terms of a timeline.
Well, we have heard from some Fed officials that it may begin to be time to talk about the timing for taper. They haven't said it's time quite yet. And they've also been very clear that they want to give the market ample notice before they make any change to policy. So if we're targeting the end of the year, the end of 2021 for the taper announcement, I do imagine that the conversation begins sometime in the August-September timeframe. Again, then they make the formal announcement in December and taper becomes a 2022 event before looking out maybe 6-12 months to the first rate increase, pushing that to potentially 2023 or beyond, very much in line with what the Fed has been saying all along and in line with what we've also seen in the latest dot plot.
John, a lot of us are long-term investors because our retirement accounts are tied to the S&P 500. We keep hearing we're going to be going sideways all summer. For those folks who do invest and have a much shorter time horizon, where do you expect we're going to be headed? Do we see much more upside for the S&P?
Yeah, I'm fairly valued at 4,250 on the S&P, so we're within a percentage point or two, of that level. So, I do think that it's going to be a position for long-term investors to reassess a diversified portfolio. And for example, if you think about, growth having done so well over the past 18 months, when you see any of these flatline markets, or even if we, get your classic textbook 6 to 10% correction, I think it's an opportunity to reassess and realign portfolios and really look towards cyclicality. Again, the way this market's traded for the second quarter, since yields peaked, we've kind of flatlined, in the cyclical versus defensive trade. But I do suspect what you're going to see, as Lindsey mentioned, if the Fed is thinking about raising interest rates now, there's going to be an inflationary impact to that. And that inflationary impact clearly is going to be growth oriented. And consequently, we position portfolios, from growth to value, from defensives to cyclicals, and focus on the cyclical sectors such as energy, materials, financials, and industrials.
Jared Blickry, I want to bring you back in here because the NASDAQ was the outperformer today, closing out, just around 0.3%. Where do you see the trend heading from here? Is the trend continue? Is it going to continue to be higher?
Well, I'll tell you what, stock's definitely climbing that wall of worry, making that incremental progress. NASDAQ heading back towards its record highs. We got those two closes day after day consecutively over 13,800. Yeah, it's looking somewhat bullish here. Nevertheless, we do have pockets of illiquidity that show up in the summer months due to that low volume and low liquidity. I just want to point something out on the Wi-Fi Interactive. This is going to be the VIX here. We got to a low of 1515. If you'll notice, that's also the 52-week low. You'd have to go back to February of 2019 to see a print that low. So that's a little bit bullish too. So looked like we were seeing some warning signs yesterday and earlier in the month, but nevertheless, things kind of clearing up a little bit now.
John, what's your take just on what we've seen play out with the NASDAQ and also some of those big tech names that we really saw lead the way last year, fell out of favor a little bit towards the beginning of this year. Are you seeing any buying opportunity there?
Well, I think, liquidity is driving a lot of that. And I think there's a comfort factor. And I think people are still letting those bets run. I think it's most important, though, for investors to really look at this point, 2022 earnings. And the consensus earnings estimate for next year is coming down slightly. So I think it'll be really important to look at, do we do $200 next year? And a derivative of that decision really comes down to what's the corporate tax rate going to be? Because if indeed we get 28%, that could hit next year's earnings by approximately 10%, which would suggest flat earnings growth next year. And I don't think anybody's priced that in just yet. Now, after last week's discussions in Washington, it looks like we could top out at 25%, and that could see us in, call it a 15% type earnings growth as opposed to flat, and we'd be certainly much more welcoming of that outcome than the prior one.